channel createURWealth. Before we start today's audio, I would request you to subscribe to our channel if you have not done. Click on the like button and share this video with the friends and your peers if you feel this will be helpful to them. Thank you.
How the fund managers are making you rich. Discover ways to tame the bear and ride the bull by Pravin Palande. Chapter 1. The Boom and the Burst. 20th October 2000, 7 pm. There were not many people present in the Birla Mutual Fund office that operated out of the State Bank of India building close to Jemmy Boy, a famous Parsi restaurant in Mumbai's Fort area. Rekha Naidu was tired after handling calls from irritated customers all through the day. A well-regarded member of the customer service department, she helped and advised investors who required assistance regarding the investment they had been made in the schemes of Birla Mutual Fund, which traded as all the mutual funds in diversified stock holdings, including thus far booming information technology stocks, the IT stocks. That evening, Rekha received a call that needed serious intervention. She looked around for a senior person from the marketing department who might be able to talk to the customer. Her eyes fell on Vikas Sachdev, a senior manager in the sales team, whose desk across the room faced her. She waved at Vikas and indicated he needed to handle this call. Vikas took the call. The customer, a man about 60 years old, who had invested 1 lakh rupees in Birla Balanced Fund at an NAV of rupees 15 in February 2000, all his savings for his youngest daughter's wedding. Having invested in the fund that had been taken technology bets when the market was at its peak. He expected his money to grow quickly. After all, there had been a tech boom grabbing to the stock market. Little did he realize that he had joined the tech boom party a little too late. By October 2000, his investment had reduced by 30% in just 8 months. The market had crashed and the client was devastated. He called Birla Sun customer service office only to cry. Sachdeva did not know how to console him. The man had lost 30% of his savings despite having invested through one of the best private sector mutual fund in the country. Now, thanks to the stock market crash, he was staring at the loss that was to him a complete knockdown shock. The client knew that equity markets were risky investment and blaming Birla Mutual Fund was out of the question. To be fair to the Birla Mutual Fund, it had given some of the best returns during the market euphoria. But when the market crashed, the fund underperformed against the Sensex. Investors lost massively. Birla Mutual Fund was just one example. Each and every fund that had invested in software during those times saw their NAVs drop to new low almost every week. Vikas spoke to him reassuringly and suggested he weighed down the downswing as the market will sure to rise. As the client's daughter wedding was still a few years away, both the client and the manager were able to heave a sign of relief at the end of the call. Most mutual funds around the year 2000 had hired the best fund managers and created a top-notch process to plan and implement their stock market investments. But when the IT bubble burst, the whole world experienced the fallout. The backdrop, the heady 90s and the IT boom. In all sorts of started in 1995 when Mary Meeker, an analyst in Morgan Stanley, published the Internet Report, which painted an optimistic world of companies that were going to change the way people worked and lived by using Internet. The report, coming as it did from Morgan Stanley, was taken seriously by the market around the world, and that led to a belief among investors that these companies were going to make a lot of money. Many new companies with crazy ideas but no growth plans listened themselves to the stock market and thus created a dot-com bubble. Meeker was blamed for fueling the dot-com bubble, which she denies. In a Wired magazine interview, she said that the investment cycle has consistent patterns. First, nobody believes that the time is right for investing. Then, a lot of people suddenly start believing in the potential of the market, followed by a boom and lastly a burst. Some of the stocks the report championed includes Netscape, AOL, Amazon.com, Yahoo and eBay. The dot-com boom was also expected to create demand for the telecom equipment market and software service provider, thereby helping countries like India, which had a reputation of quality software developers. During 2000 and 2001, the Indian software sectors registered a growth of 55% to touch $8.26 billion. And much to this was related to the dot-com or the technology boom in the US market. The report highlighted US-based technology companies which were expected to do well because of their dot-com prowess. In the meanwhile, the editor of the Red Herring, a popular technology magazine that covered the IT field, had come to India in 1999 to address that Indian IT companies. His views differed strongly from Meeker's. He felt there was a little point in trusting the dot-com boom that was taking place in the US market and expect a similar kind of internet boom in the Indian market, adding that Indian companies had nothing to feel euphoric about it, unless they thought the consumer in their own country would start buying an washing machine over website. In his view, Indian companies could do better to concentrate on outsourcing opportunities being made available by the US. He was right. The Indian retail industries at that time was not big. Indians at that time did not use the online space to buy items for retail use, such as groceries, clothing, or even books. Big Bazaar was the only just begun launched and malls were yet to appear in most cities. Nevertheless, by the late 90s, everyone had begun to talk about how the internet was going to change the way people live and how it could even impact the way trading took place in financial markets. Anything.com was good. Though Morgan Stanley report had highlighted only US-based companies, the euphoria of the US market had reached India. Not just thanks to the media, but also thanks to the change the way Americans did business. Indian companies listed on the Indian stock markets during that period were trying very hard to establish themselves as technology companies in India. But at the end of the day, they were basically doing labor arbitrage. In other words, they were getting work done by the Indians for a fraction of what they could cost if they would get the same work done by a US fellow in the United States. But the Indians they hired weren't complaining. The money was good. Everybody's neighbor with an engineering degree or an NIIT qualified cousin was hopping abroad on an outsourcing company or heading off to the US in that era. Meanwhile, investment bankers in the United States continued to proclaim that internet was the future. Internet was omnipresent. Internet was God. Stocks in these companies became a necessity. The buzz around dot-com companies in the 90s also led to a strong investor bias in their favor in India. The dot-com boom in the US was replicated in the form of software and IT boom in Indian markets. Companies associated with software and technologies were getting better valuation than those related to other sectors. But there was still a desperation to identify with the dot-com boom. When the article appeared in the newspaper announcing Hindustan Unilever, then called as Hindustan Lever, wanted to build a website, its stock price skyrocketed. Those were the real heady times. Any business that had the presence or wanted to make its presence felt on online platform, however small, traded at a premium. The dot-com boom took a different meaning in the Indian stock market. investors were happy to pay a premium for the companies with the website. Any company that made even a cosmetic change to its name and tagged as example a .com received a good valuation. Companies wanted to change their names so that they could be identified more as a .com player than brick and mortar firms. A senior finance officer at McDowell's Spirit made a statement that in those heady days, that only way to get higher valuation for his company was to build a www.mcdowells.com. The officer was right to a certain extent. Many companies, especially those that worked in finance or leasing activities, did change their names to sound similar to those of its software companies and enjoyed higher valuation for some time. Companies in telecom, media and technology sector also have been analyzing on new parameters as opposed to the old established metrics such as cash flow, profit after tax and sales growth. Analysts label metrics in this new tech era in a different way. Eyeballs, number of hits, page views, cash burn. Cash burn simply means that the rate at which new companies financed by venture capitalists use their money before generating any real profit. A high degree of cash burn was considered positive at that point of time, completely in variation with its previous understanding of business. The amazing thing was that the more the company grew in sales, the greater were its losses, as each transaction was being made at a loss. Around that time, a new ratio called as a price earning ratio to growth, PEG, also started gaining grounds. Companies that had higher growth rates would also have a higher PEG ratio. Higher PEG ratio also meant that the valuation of these companies were going through the roof. The PEG ratio was also used to normalize the PE ratio. Here, it's important to understand that the price earning ratio or the PE ratio is one which values companies based on their net profit. A company with a higher net profit will also have a higher market price and a market capitalization, which is the total value of the company if you were going to buy all the shares of the company. A higher PE ratio means the company is growing its net profit at a faster rate. But what happens when the PE ratio starts to trade at 100 times? For example, if the company's net profit is rupees 100 and the market value of the share is 10,000 rupees, then the PE ratio would become 100. In the .com era, the stock market was assuming that the companies with a PE ratio of 100 was going to double its earning every year. But when some skeptics started questioning these assumptions, the market bulls started talking about the PEG ratio. Generally, the present PE ratio or the PE multiple trades at future earning potential of the earnings per share, the EPS, or the net profit of the company. The idea was simple. If a company has a PE of say 100 with a growth rate of 100%, then the PE would be 1. So, in Feb 2000, when the PE multiples in the IT index was 420, its expected growth rate profit was 100%. The PEG ratio was 4.2, which is very high figure. Some investors speculated that the growth rate could be 420% and thus brought the PEG ratio to 1. The lower the PEG ratio, it's used to justify the high PE ratio, thus luring the investors into buying the software at the technology stock. The entire valuation game was based on ridiculously high growth rates cited in the research reports. For instance, back then, software companies like Mphasis had a PE multiple of 2606, that is 2606. You do the numbers. This was the time when the Crest Communications, a small software company, had a market capitalization of 568 crores, and Esher, a company that was making the name as the biggest competitor to Bajaj Auto, had a market capitalization of only 82 crores. You can see on the screen a table which talks about the market capital in the 90s. This was the market that did not make any sense. The bloodbath. By 1st April 2000, the stock market bloodbath had begun. Let's cite the case of the famous businessman who we will call as CR, who had sold his business to an international cold drink company for a consideration of 150 crore rupees in the 90s and invested the entire amount in the mutual fund. When CR wrapped up the process of selling and investing his earnings from the sale into mutual fund, then the finance minister P. Chidambaram introduced section 54EA and section 54EB in the budget speech in 1999. Under this section 54EA of the Income Tax Act, investors were exempted from paying capital gain tax if they had invested in mutual fund for more than 3 years. CR had invested in a fund of around rupees 10 lakhs which went up to 17 lakhs but within a year crashed to rupees 5 lakhs. He had not extracted his investment when the returns were high because he needed to keep the amount invested for at least 3 years to receive the full benefit of section 54EA. When the price crashed, CR, despite all his business acumen, suffered a huge loss. As late as 1999, Infosys founder Narayan Murthy said he did not foresee a negative downstream in the Infosys earning. Narayan Murthy was right. Nothing was wrong with the fundamentals of the IT sector. Mr. Murthy had said this in his video interview given to Arinod Dange, the research head in Credit Loans Security Asia, CLSA. Dange had asked Mr. Murthy, "When do you think Infosys will report a negative earnings growth year?" To which Mr. Narayan Murthy had replied, "It won't happen at least for a decade." The cause. How do you know that the dot-com has led to a crash? Narayan Murthy was right. There was nothing wrong with the fundamentals of the IT sector. There were two other factors to play which caused the downside. The first, as explained earlier, was that globally IT growth took an expected beating. Expected, considering the very high starting point of growth, thanks to the very high valuation of the IT companies globally. In the US, or for instance, Priceline, a company and a website that helped users get discount on travel related purchases, was valued more than the valuation of all the airlines in the US put together. In India, similarly, the combined market capitalization of Infosys and Wipro was higher than the combined market capitalization of the entire pharma, auto and fast moving consumer goods FMCG sector in 1999. The second factor was explained by Dange himself in an interview to Forbes India. Dange explained that the crash of 2000 was related to the dot-com sector in the US and not the software sector of India. The dot-com sector was a new idea where it was assumed that the people would buy goods online and companies would do their raw material sourcing using the technology that powered the internet. Software companies concentrated on building IT, and that included powering dot-com business on the internet. Unlike dot-com business, there were profitable businesses growing at fast rate. A lot of big US-based companies were outsourcing their software-related work to Indian companies. Dange pointed out that unlike in the US, software companies in India were profitable. He brought out another report in the year 2000, the Web is Cast, in which he talked about the technology or the dot-com initiative companies like Asian Paints and the ICICI Bank. In the year 2007, Dange went on a joint India Infoline (IIFL) as a research head for the brokering organization and is now his chief strategy officer. He remains a staunch believer in the quality of the Indian software companies, but feels that the valuation parameter during the heady 90s were completely off the charts, and the investors' expectations were also very high. Though in reality, One cannot invest blindly and expect high returns, but back then, investors believed in fairy tales. In fact, it would not be wrong to say that the dot-com boom was the biggest fairy tale in the life of the late 90s broker. Risk, which was looked in terms of a standard deviation up until then, was just a statistical number. Investors were willing to outlook risk at all. The equity investment came with the rider. Mutual funds are subject to market risk. Read all the scheme related documents carefully before you invest. With this statement, fund managers of the 90s were free to do whatever they wanted with the portfolio. There was no concept of diversification, and the fund managers remained focused on the concept of returns through the dot-com boom. The biggest fund managers of that time was allocating 70 to 80% of the entire portfolio in just 2 or 3 stocks. These stocks in most cases were highly illiquid and often from the same sector, and the popular choice from the IT sector. The Securities and Exchange Board of India, SEBI itself, was new to mutual funds. Though there were controls on expense and entry load, fees that was charged to the investor for joining a scheme, and the exit load, fees which was charged at the time of leaving the scheme, SEBI did not really have the strong portfolio management guidelines. The regulators probably wanted to give some leeway to the nascent industry that was trying to grow. After all, there were few players in the business. At most, there were around 30 odd equity schemes, of which the bulk belonged to the babus from the public sector. So why bother? But some of these funds were single-handedly beating the index black and blue. Everything was going well for the mutual fund industry until March 2000. When the IT bubble burst, by that time those who were in the dot-com bubble realized that the market was crashing, and it was too late. Nor could they be really blamed. The global outsourcing market had been rapidly expanding and had managed to capture the attention of Indian fund managers. India did not really have star fund managers at that point of time, but investors looking for a masiha had narrowed their search down to few names that were sure would put them on the road to riches. People like Samir Arora and Bharat Shah, the star fund managers. Bharat Shah gained recognition in the late 90s for buying some of the best technology stock that metamorphosed into lucrative companies in the following years. First companies into limelight where he took were Birla Mutual Fund, where some of the schemes primarily invested in the software and the pharma segment. The scheme yielded phenomenally high returns on the back of the stock of companies like Infosys and Wipro, which Shah purchased at a very low valuation. Bharat Shah became so popular in the late 90s that his name itself was a guarantee that high returns in the software stock. He truly was the original star fund manager in the Indian market. When Shah chose a particular stock, other rookie fund managers blindly followed the suit. After Birla Balanced Fund collected rupees 335 crores in its initial fund offering in September 1999, Shah spoke on 12 December 2000 to Value Research Online about his faith in the IT sector. It was just a few months before the market crashed. He said, "Our exposure is so called as ICE stock, which reflects our faith in the ability of some of the companies in this sector to deliver superior free cash flow in the future." Our investment style is bottom up, and the categories like ICE or otherwise are incidental. We will invest at a reasonable price in any company that shows promises of sustained performance without worrying about which sector it comes from. We hope to show attractive portfolio returns as the relatively superiority of the cash flow gets reflected in the share prices. People had a lot of faith in Shah. So when he moved out of Birla Mutual Fund, the market crisis had a major impact on the Birla Mutual Fund. as the fund managed by Mr. Shah were now trading at rupees 10, which was the NFO value. There was a lure as everyone wondered how things could turn around for the fund house. But Birla Mutual Fund managed it very well. A few may recall that Kothari Pioneer was the first private sector mutual fund in the country. But it was eventually Birla Mutual Fund that became the training ground for future senior managers in the industry. There was a high likelihood that the CEO in the mutual fund industry today has been with Birla Mutual Fund at some point in their career. Many who left Birla Mutual Fund in the early 2000s, especially after the crash, were successful managers in the private sector mutual funds and remember those heady days in great detail. Interestingly, Shah had been able to move out of some of the stocks before they went bust in the end of 2000. He knew that the roots of the dot-com crisis were global and not of Indian control. Even Morgan Stanley, the first foreign return oriental growth fund in the sector, have collected 1,000 crore rupees at the launch in 1994. Eventually left many first-time investors bitterly disappointed and feeling that they had burned their fingers by investing in mutual funds. Rather than keeping their money safe in the fixed deposit or saving accounts in their local bank. Indeed, it was Shah who did a lot of Indian mutual funds investor. He brought mutual funds out of the shadow cast of the market crash and the Morgan Stanley fund D-table. Bharat Shah's words on risk as a concept on finance were also immortal. Risk is not what you own, but risk is what you don't understand. If you understand it, it's not risky. Shah, who is part owner of the Ask Investment Manager, Ask IM, a wealth management firm, now manages a total asset around 25,000 crore rupees as on December 2016. And his 9,200 crore December 2016 belongs to the portfolio management scheme, an investment product customized for extremely rich who want to invest in stock market. Seek Mr. Shah's advice to do so. Over the last 10 years, PMS had returned 26% to its investor at par with the top diversified mutual fund in the country. His path-breaking investment strategies will be discussed later. Thank you.